Hello and welcome to the session. Today we are going to look at liquidity coverage ratio. This is going to be a very brief explanation and underlying logic behind construction of this ratio. Back in 2007, many financial institutions failed to adequately monitor and control liquidity risk. This led to a lot of difficulties. So the Basel Committee on Banking Supervisions wanted to help improve the banks manage their liquidity risks better. They wanted to address two types of liquidity risks, one from a short term context and the other one from a structural resilience perspective. To manage the first one, the BCBS, Basel Committee on Banking Supervisions, introduced something called LCR. And to manage structural resilience, they introduced NSFR. So LCR stands for liquidity coverage ratio, NSFR stands for net stable funding ratio. We'll look at liquidity coverage ratio today, and NSFR will be covered in another video. So what really is LCR trying to address? Is it just bank specific risk, or is it both bank specific and market wide stress scenarios? LCR hopes to improve both. It wants banks to manage both bank specific and market wide stress. So, liquidity coverage ratio says 30 calendar days stress period is the minimum period deemed necessary for corrective actions to be taken by a bank's management. So, a bank needs to be prepared to manage a 30 calendar day stress scenario. What really happens in a stress scenario? Cash flows out. But is that all cash outflows? Not necessarily. If a bank has got a lot of liabilities in the form of deposits or off balance sheet commitments, both of them can result in outflows. A bank will also have a number of assets or balance sheet items which are expected to generate cash on maturity. So these assets and balance sheet items are expected to generate cash even during a stress scenario. So what does net cash flows really mean? In case of outflows, for all of them, a particular statutory ratio is applied. It could be 100% outflow, it could be a 50% outflow, or it could be a 25% outflow. I'm just making up numbers here. What does 100% outflow means? It means all the liabilities are expected to be withdrawn during the stress period, that is during the next 30 calendar days. A 50% statutory ratio means 50% of outstanding balances or liabilities are expected to be withdrawn in the next 30 calendar days. So you get the idea. If a bank has got $1 million in each one of these categories, then in this case, all of 1 million will be outflow. And in the second scenario, 0.5 million. And in the last one, 0.25 million. This will be the gross outflow for a bank in our example. That's 1.75 million. What are inflows? For all the assets, again, LCR applies an inflow ratio. So for each asset items, there could be different inflow ratios, just like outflow ratios. So if a bank has, let's say, a $500,000 assets, and for simplicity, let's assume they have a 50% inflow factor. That means a bank will have 0.25 million of inflows. So in this case, net outflow, net cash outflow means 1.75 minus 0.25 million. Therefore, a bank in this case is expected to have 1.5 million net cash outflows. So now this gives us a very clear picture of how much cash a bank needs in the next 30 days to manage a stressed situation. Now let's look at how LCR ratio requires a bank to manage this net cash outflow. A bank should maintain enough high quality liquid assets to manage this 1.5 million outflow we saw in the previous slide. What really are high quality liquid assets? It could be cash or it could be cash equivalents. When I say cash equivalents, I refer to assets that can be quickly converted into cash through sales with no significant loss of value. LCR actually allows a few different categories of HQLA. The first one is called level 1. This is simply the best quality of HQLA a bank can hold, and there are no limits. This is level 1. And then we have level 2. A bank cannot hold more than 40% of its HQLA in level 2. So for level 2 assets, maximum is 40% of total HQLA. But it does not stop there. Level 2 is actually further split into two categories, level 2A and level 2B. In level 2A, every asset a bank holds gets a 15% haircut, and only the balance 85% are treated as HQLA. In case of level 2B, there are actually more stringent requirements. Level 2B cannot be more than 15% of total HQLA, and then it also gets a much larger haircut compared to level 2A. So this is the requirement on high quality liquid assets. If we take a moment to go back, LCR really asks a bank to look at what will be the net cash outflows over the next 30 calendar days, and then it wants the bank to maintain high quality liquid assets for this expected net cash outflows. If you have watched till the end, I hope this video was useful to you. Let me know your thoughts in the comment section. Thank you.